On February 2nd, 2026, the Institute for Supply Management released a report that sent shockwaves through the financial media. The ISM Manufacturing Purchasing Managers Index surged to 52.6%. That's a massive 4.7-point jump from December's 47.9%. Headlines everywhere screamed the same message. Manufacturing is expanding again. The recession is over. The economy is recovering. Wall Street celebrated. Stocks rallied. Analysts upgraded their forecasts. But there's one tiny problem. The employment component of that exact same report told a completely different story. The employment index came in at 48.1%. That means manufacturing employment is still contracting. Not just contracting this month. Contracting for the 28th consecutive month. Let me say that again. 28 straight months of employment decline. That's over 2 years of relentless job losses in the manufacturing sector. In fact, manufacturing employment has contracted in 36 of the last 37 months, going back to January 2023. So how can manufacturing be expanding while firing workers at the same time? How can the headline number show growth while the employment number shows collapse? This is the contradiction that perfectly captures what is broken about the American economy in 2026. The top-line numbers look fine. GDP is growing. Stock markets are hitting all-time highs. Manufacturing indexes are expanding. But underneath the surface, real people are losing their jobs. Real families are struggling. Real workers are being replaced by automation and AI. This isn't a recovery. This is a mirage. And the ISM report, when you dig into the actual data instead of just reading the headlines, exposes the truth. Companies are getting more orders. That's why the PMI is up. But they're not hiring people to fill those orders. They're firing people. They're cutting headcount. They're investing in automation instead of workers. For every one company hiring, 2 companies are reducing headcount. That's a direct quote from the ISM report. 2 to 1. Layoffs are outpacing hiring by a factor of 2. And yet the headline says, manufacturing is expanding. This is why Americans don't trust economic data anymore. This is why consumer confidence just crashed to its lowest level since 2014. Because the numbers and the reality don't match. So let's break down why the PMI suddenly jumped from 47.9% in December to 52.6% in January. That's a massive one-month surge. The biggest driver was the new orders index. It exploded from 47.4% in December to 57.1% in January. That's a 9.7-point jump, the highest reading since February 2022, nearly 4 years ago. On paper, that looks incredible. Companies are getting flooded with new orders. Manufacturing is roaring back to life. But here's what the headlines didn't tell you. This isn't a sustainable recovery. It's a temporary spike driven by 2 very specific factors. First, January is the post-holiday reorder month. Every year, companies replenish inventory after the holiday shopping season. They stock up on raw materials. They place orders for components. This happens every January. It's seasonal. It's predictable. It's not a sign of economic strength. Second, and this is the critical part, companies are panic buying to get ahead of tariffs. Trump's tariff threats are forcing manufacturers to accelerate their purchasing. If you think steel prices are going up 25% next month because of tariffs, you buy all the steel you can right now. If aluminum is about to get hit with import duties, you stockpile it today. That's not demand growth. That's fear-driven hoarding. The ISM report itself confirmed this. One of the direct comments from survey respondents said, "Some buying appears to be to get ahead of expected price increases due to ongoing tariff issues." Translation? Companies aren't buying because business is booming. They're buying because they're terrified of what's coming. And here's the problem with panic buying. It doesn't last. Once companies have stockpiled enough inventory to weather the tariff storm, the orders stop. The new orders index crashes back down, and then we're right back where we started. Or worse, because now companies have bloated inventories they can't sell, warehouses full of materials they overpaid for. And when that happens, they'll cut production, they'll reduce orders, and they'll fire even more workers. This isn't an expansion. This is the calm before the next storm. The numbers look good for 1 month because companies are frantically preparing for disaster. That's not recovery, that's panic. Now let's talk about what's really happening to workers. The ISM Employment Index came in at 48.1% in January 2026. Any reading below 50 means contraction. Jobs are disappearing, not being created. And this isn't new. Manufacturing employment has been contracting for 28 consecutive months. That's every single month since October 2023. In fact, if you zoom out even further, employment has contracted in 36 of the last 37 months, going back to January 2023. There was 1 month, just one, where manufacturing added jobs. The rest, relentless, brutal job losses. But here's what makes this data even more disturbing. The ISM collects qualitative comments from purchasing managers at manufacturing companies across the country. These are the people on the ground making hiring and firing decisions. And the ratio they're reporting is shocking. For every one comment about hiring workers, there are 2 comments about reducing headcount, 2 to 1. Layoffs are outpacing hiring by a factor of 2. The most common strategies mentioned, layoffs and not filling open positions. Companies aren't even bothering to replace workers who quit or retire. They're just letting headcount shrink through attrition. One survey respondent said it plainly, "Managing headcounts is still the norm as opposed to hiring." Another said, "Morale is very low across manufacturing." These aren't anonymous internet complaints. These are executives and managers reporting directly to the Institute for Supply Management. And what they're saying is crystal clear. Nobody's hiring, everybody's cutting. Out of the 6 major manufacturing industries tracked by ISM, only 2 reported employment growth in January: transportation equipment and computer and electronic products. The other 4, all contracting. Food, beverage, and tobacco products, contracting. Machinery, contracting. Fabricated metal products, contracting. Chemical products, contracting. And even in the 2 industries that reported growth, the word they used was modest. Not strong, not robust, modest. Meanwhile, the industries cutting jobs are doing so aggressively. This is the reality behind the 48.1% employment index. It's not just a number, it's tens of thousands of real people losing their livelihoods. It's families struggling to pay bills. It's workers who thought they had stable manufacturing jobs watching their plants downsize, automate, and eliminate positions. And it's been happening for 28 straight months with no end in sight. While employment is collapsing, prices are exploding. The ISM Prices Index came in at 59% in January, up from 58.5% in December. That's the 6th consecutive month of price increases, and 59% is dangerously high. Anything above 50 means prices are rising. At 59, they're rising fast. Here's what's driving the surge. Steel prices are skyrocketing, aluminum costs are soaring, and the culprit is tariffs. Trump's trade war is making raw materials catastrophically expensive for American manufacturers. Companies that rely on imported steel are getting crushed. Tariffs on Chinese metals, tariffs on European imports, tariffs threatened on every trading partner that doesn't bend to White House demands. And manufacturers have no choice but to absorb these costs or pass them on to consumers. But here's the vicious cycle. When input costs rise, manufacturers have 2 options. Option 1, raise prices and risk losing customers. Option 2, eat the cost and destroy your profit margins. Most companies are choosing option 2 in the short term. They're absorbing the pain, but they can't do that forever. Eventually, those costs get passed down the line. Prices for finished goods rise. Consumers pay more. Inflation stays elevated. And the Federal Reserve can't cut interest rates because inflation is still too high. This is stagflation. Rising prices combined with falling employment. It's the worst possible economic scenario. And it's happening right now. The panic buying we talked about in part 2 is making this worse. Companies are stockpiling steel, aluminum, and other materials before tariffs hit. That surge in demand is pushing prices even higher. It's a self-fulfilling prophecy. Fear of price increases causes panic buying. Panic buying drives prices higher. Higher prices justify more panic buying. The cycle accelerates. And once companies have their stockpiles, demand will crash. Prices might fall temporarily. But the underlying inflationary pressure from tariffs isn't going anywhere. Manufacturers are trapped. They can't hire workers because margins are tight. They can't invest in growth because costs are unpredictable. They can't plan for the future because tariff policy changes every week based on whatever Trump tweets. This is not a healthy economy. This is an economy on life support held together by short-term stockpiling and prayers that tariffs don't get worse. The employment index isn't just an abstract number. It represents real companies firing real people. And January 2026 saw some of the most brutal layoff announcements in years. Let's start with Amazon. In January alone, Amazon announced it was cutting 16,000 jobs. But that's not the full story. Back in October 2025, Amazon had already announced 14,000 layoffs. That means in just 3 months, Amazon eliminated 30,000 positions. 30,000 people. Gone. These aren't warehouse workers being replaced by robots, though that's happening too. These are corporate employees, managers, analysts, engineers, people who thought they had secure white-collar jobs at one of the most valuable companies in the world. Then there's UPS. The logistics giant announced plans to cut 30,000 operational jobs throughout 2026. UPS blamed declining package volumes and the shift toward automation. The company is investing billions in sorting facilities that require fewer human workers. The jobs are disappearing permanently. They're not coming back. Nike announced 775 job cuts in January as part of its supply chain automation initiative. The sneaker giant is replacing human workers with AI-driven inventory management systems and automated distribution centers. The irony? Nike's revenue is still growing. They're making more money than ever. They just don't need people anymore. And these are just the big names that make headlines. Across the country, over 100 companies filed WARN notices in January 2026. WARN stands for Worker Adjustment and Retraining Notification. It's a federal law that requires companies to give 60 days notice before mass layoffs. When a company files a WARN notice, it means hundreds or thousands of jobs are about to disappear. Manufacturing facilities in the Midwest, tech companies in Silicon Valley, retail chains closing distribution centers. The layoffs are broad-based and accelerating. But here's what makes this even more insidious. Many companies aren't doing mass layoffs. They're doing stealth cuts. They're not filling positions when people quit. They're offering early retirement packages. They're restructuring departments and eliminating roles quietly. These cuts don't show up in WARN notices. They don't make headlines, but they're happening everywhere. And when you add it all up, the result is 28 consecutive months of employment contraction in manufacturing. The jobs are disappearing slowly, quietly, relentlessly. What we're witnessing in 2026 is a new kind of economic phenomenon. Economists are calling it the low hire, low fire economy. And it's a nightmare for workers. Here's how it works. Companies are not doing massive headline-grabbing layoffs like they did during the 2008 financial crisis or the 2020 pandemic. There are no scenes of thousands of employees being escorted out of office buildings in a single day. Instead, companies are implementing hiring freezes. When someone quits or retires, that position simply doesn't get filled. Departments get restructured. Teams get merged. The work gets redistributed among fewer people. Headcount shrinks gradually, almost invisibly. This strategy has a name: zero-growth headcount management. Companies maintain just enough staff to keep operations running, but they refuse to expand. They're not betting on growth. They're hunkering down and waiting for clarity, waiting for tariff policy to stabilize, waiting for the Federal Reserve to figure out what it's doing, waiting for consumer demand to rebound. And while they wait, workers suffer. The problem with the low hire, low fire approach is that it creates invisible unemployment. The official unemployment rate looks fine because mass layoffs aren't happening. But displaced workers can't find new jobs because nobody's hiring. If you lose your job at Amazon, where do you go? UPS isn't hiring. Nike isn't hiring. Every company in your industry has a hiring freeze, so you end up underemployed, taking a job that pays less and uses fewer of your skills, or you drop out of the labor force entirely. You stop looking. You don't get counted in the unemployment statistics. But you're absolutely a casualty of this economy. And here's the cruel irony. GDP is still growing. The economy expanded at a 4.4% annualized rate in the third quarter of 2025. Corporate profits are strong. The stock market is near all-time highs. But none of that growth is translating into jobs. Companies are producing more with fewer people. They're using automation, AI, and productivity gains to increase output without increasing headcount. It's great for shareholders. It's great for executives. But for workers, it's a slow-motion disaster. You're not getting fired. But you're also not getting hired. You're trapped. And the economy that looks healthy on paper is leaving you behind. The reason companies can grow without hiring is simple. Artificial intelligence. AI job postings surged 130% in 2025. Every company is looking for AI engineers, machine learning specialists, and data scientists. But for every AI role created, dozens of traditional jobs are being eliminated. Amazon is the perfect case study. The company just announced 30,000 job cuts over 3 months. At the same time, Amazon is investing $35 billion per quarter in AI infrastructure, data centers, cloud computing, machine learning models, automation systems. They're not cutting jobs because business is bad. They're cutting jobs because AI does the work better, faster, and cheaper. Amazon's warehouses are increasingly automated. Robots move packages. AI systems optimize routes. Machine learning algorithms predict demand and manage inventory. The human workers who used to do those jobs? Gone. And it's not just Amazon. Across manufacturing, companies are rotating labor operating expenses into AI capital expenditures. Instead of paying salaries and benefits to human workers year after year, they're making one-time investments in automation systems. The math is simple. A human warehouse worker costs $40,000 per year plus benefits. Over 10 years, that's $400,000 minimum. An automated sorting system costs $200,000 up front and lasts 15 years. The AI pays for itself in 5 years, then generates pure profit for the next decade. Every CFO in America is doing this calculation. And every time they run the numbers, the answer is the same. Replace humans with machines. Nike's 775 layoffs, AI-driven supply chain management, UPS cutting 30,000 jobs, automated sorting facilities, manufacturing employment contracting for 28 straight months, AI and robotics. But here's the problem. The workers being displaced are generalists. They don't have AI skills. They can't code. They can't build machine learning models. And even if they tried to retrain, the market is already flooded. There's a glut of mid-level workers trying to transition into tech roles. Meanwhile, the AI jobs require advanced degrees, specialized training, and years of experience. The laid-off warehouse worker or manufacturing line supervisor isn't going to become an AI engineer. They're going to become unemployed, or underemployed, or they're going to give up entirely. This is the AI displacement crisis, and it's accelerating faster than anyone predicted. Here's why this matters so much. Now, what we're seeing in the ISM report is the textbook definition of stagflation. Rising prices combined with falling employment. It's the worst possible economic scenario. And it's exactly what's happening right now. Let's break down why stagflation is so dangerous. In a normal recession, prices fall because demand collapses. People lose jobs, stop spending, and businesses lower prices to attract the few customers left. It's painful, but at least things get cheaper. The Federal Reserve can cut interest rates, stimulate the economy, and eventually pull us out. In a normal expansion, employment rises along with prices. People get jobs, wages go up, spending increases, and some inflation is the natural result. The Fed can raise rates to cool things down if inflation gets too hot. But stagflation is different. Prices are rising because of supply-side shocks. Tariffs make imported materials expensive. That cost gets passed to consumers. But at the same time, companies aren't hiring because demand is weak and margins are compressed. So you get the worst of both worlds, rising prices and falling employment. The Federal Reserve is completely helpless in this scenario. If they cut interest rates to stimulate hiring, they make inflation worse. If they raise rates to fight inflation, they destroy what's left of the job market. There's no good option, just bad and worse. And that's exactly where we are in February 2026. The ISM Prices Index at 59% means costs are surging. The Employment Index at 48.1% means jobs are disappearing. Consumer confidence is at a 12-year low because people can feel this happening. They see prices rising at the grocery store. They see their friends getting laid off. They read headlines about manufacturing expanding and think, why doesn't it feel that way? This is the 1970s all over again. Back then, oil shocks and inflation combined with high unemployment created a decade of economic misery. It took brutal interest rate hikes by Paul Volcker, rates above 20%, to finally break the cycle. And even then, it caused the worst recession since the Great Depression. That's what stagflation does. It breaks economies, and we're walking right into it. So what do you do when manufacturing expands on paper but fires workers in reality? When prices are surging but jobs are disappearing? When the headlines say recovery but the data screams stagflation? First, don't trust the headline numbers. The ISM at 52.6% sounds great until you dig into the employment component at 48.1%. GDP growth at 4.4% sounds amazing until you realize it's not creating jobs. Always look beneath the surface. The top line numbers are designed to make you feel good. The details tell you the truth. Second, secure your job right now. If you're employed, make yourself indispensable. Take on critical projects, build relationships with decision makers, document your value. In a low-hire, low-fire economy, companies keep the workers they absolutely cannot afford to lose. Make sure you're one of them. If you're in manufacturing, be realistic about your industry. 28 straight months of employment contraction isn't a blip, it's a trend. Start planning your exit strategy before you're forced into one. Third, build a 12-month emergency fund, not 6 months. In previous recessions, the median unemployment duration was around 6 months. But in this low-hire, low-fire environment, it could take a year or longer to find a new job. Nobody is hiring. Saving 12 months of expenses gives you runway to weather a prolonged job search. Fourth, upskill in AI or get left behind. I'm not saying everyone needs to become an AI engineer, but you need to understand how AI impacts your job and learn to work alongside it. The workers who survive are the ones who augment AI, not the ones AI replaces. Take online courses, get certifications, learn the tools that are transforming your industry. Fifth, prepare for stagflation. Rising prices and stagnant wages mean your purchasing power is shrinking. Cut unnecessary expenses now. Pay down high interest debt. Lock in fixed rate financing if you can. And if you haven't seen our previous videos on the consumer confidence crash hitting 84.5, the lowest since 2014, or Bitcoin's 40% collapse, wiping out $800 billion, go watch them now. Everything is connected. The economy isn't recovering, it's fracturing. And the only way to survive is to see it coming and prepare before everyone else does.